Hello, and welcome to What's the Deal, our investment banking series on JP Morgan's Making Sense podcast. I'm your host today, Amaury Guzman from our Leverage Finance desk. Today, I am joined by Managing Director and co-head of our direct lending team, Jeff Bracchitta. And we're here to explore the recent evolution of the direct lending market, the trends driving its changes, as well as our take on the outlook going forward. Jeff, thank you so much for joining me today.
Thank you for having me.
Before we get started, Jeff, can you tell us a little bit about yourself and your career at JP Morgan?
Certainly. I joined the firm in 2001 around the time of the JP Morgan and Chase merger. My first role was a combination of credit and coverage analyst. After about 2 or 3 years, I joined the leverage finance team. And for nearly 20 years, I covered a variety of sectors, arranging traditional bank loans and institutional term loans and underwriting high-yield bonds for both corporate and sponsor-backed borrowers. In 2022, my colleague Marco Prono and I came together to formalize our direct lending team.
Great. So to jump right in, direct lending is a part of the market that is driving a lot of focus these days from market participants. Can you walk our listeners through the history of the direct lending market and the size of the product class today?
Sure thing. Historically, direct lending was known as a funding source for middle market leverage buyouts or providing junior debt structures such as mezzanine financing. Circa 2010, the asset class totaled about $310 billion. Post-financial crisis, leveraged middle market lending done by direct lending funds expanded in the wake of leveraged lending guidelines applied to the banks. To create efficiency and increase attractiveness of the product, participants in the direct lending market created a structure that collapsed traditional senior-junior tranching into a simplified unitranche structure. Over time, those same funds began providing revolving credit facilities, further increasing efficiency for borrowers. As a convenient, committed source of capital, this became a significant portion of financings for middle market borrowers with under $50 to $75 million of EBITDA and total loan packages generally sub $500 million. Fast forward to today, third-party estimates frame the direct lending market at approximately $1.7 trillion, with about half of that as performing unitranche lending, or what people are calling direct lending today. Rounding out the rest of the market as mezzanine, distressed lending, asset-based lending, etc. In total, this is similar size to the broadly syndicated loan and high-yield bond markets, which sit at roughly $1.9 and $1.8 trillion respectively, framing the relevance of direct lending as a financing alternative.
It's really interesting. And how has second lien played into all of this?
Good question. Growth in second lien lending as an alternative to high yield and leveraged buyouts accelerated over the past, call it 10 years or so. Many of these second lien facilities were privately placed, which created sponsor relationships with lenders and arranging capabilities away from banks. Over time, private equity capital markets teams tapped those relationships to directly arrange first lien financings as well.
And are there any other factors that you would highlight that have also played a role?
Yes. In addition to filling a void for leveraged middle market borrowers, direct lenders provided financing in other areas such as venture, tech, healthcare, and ARR lending, which helped proliferate the market. The concept of jumbo financings, or deals north of $1 billion, came about for high EV tech and healthcare companies seeking leverage outside of historical norms. Direct lenders also offered unfunded capacity in the form of delayed draw term loans, which helped many private equity firms roll up entire industries, most notably in residential and professional services. This form of growth capital was very appealing in buy and build strategies and helped grow the market.
I see. And more recently, say when M&A was red hot in 2021 and 2022, how did that play out in the direct lending realm of the market?
So that period is really when direct lending entered a new level of scale and penetration, but we need to split the time frame slightly. 2021 was robust all around, with $3 trillion of U.S. M&A volume, nearly double the average of the prior 15 years. All markets were firing, and direct lending was going through an explosive growth phase, financing middle market and upper middle market LBOs, as well as certain large cap tech and healthcare deals. The trend continued into 2022. However, the music stopped in the syndicated loan and high-yield markets around the timeframe of the Russia-Ukraine conflict, creating dislocation and pause in the public markets. Direct lenders, who similar to private equity were not as impacted by market volatility, stepped in as the main financing source for companies of all sizes in what was a challenging market. On the back of rate increases, which began mid-2022, the market recalibrated on credit spreads and risk tolerance, meaning higher costs of debt and lower leverage, but deal activity continued. M&A volumes were approximately $1.6 trillion in each of 2022 and 2023. During this period, direct lenders made an even larger name for themselves, with fund managers able to generate double-digit returns for senior secured positions, resulting in a surge in fundraising. These converging factors created the so-called golden age of direct lending, when 90+% of LBOs during the 12 months from Q2 22 to Q2 23 were financed by direct lenders.
It's interesting to recount the evolution of the product class, starting with the mezzanine structures with relatively low volumes to a much more efficient product with lending volumes that compare to the more traditional syndicated markets. On that point, what's your take on the balance or the dynamic between the direct lending and the syndicated markets?
So both markets are very much open and receptive to both new money and refinancing activity. It feels like the two markets have found a balance following a wave of cross-market refinancings in both directions through early 24. The dance between the syndicated and the direct markets has resulted in more than $45 billion of volume moving between the two markets via refinancing. As mentioned earlier, in late 2022 into 2023, when direct lending was essentially the only game in town, we saw private add-ons to existing syndicated structures at then market rates. Naturally, with the syndicated market back, many of these tranches are being refinanced at today's lower rates, some in the syndicated market and some repriced with the existing direct lenders. On the flip side, CLO appetite for B3, B- paper and below has diminished, and some of the B3 or CCC names have refinanced with direct lenders, even with scaled capital structures. Much of this activity falls into the special situations portion of the market, but it's worth noting. A significant plus for the JP Morgan platform has been our ability to toggle between these markets to help borrowers find the best solution for a particular capital need at that particular time.
That's a great point, Jeff. I know that sometimes market participants point to some differences between the market, including sometimes cost. Can you speak to what was the cost differential between the two and what drives it?
Yes, there are two main drivers when you compare cost of capital between direct lending and broadly syndicated markets. First, the unitranche spreads reflect a combined first lien, second lien structure, so there is incremental risk that needs to be compensated for. Second is the illiquidity of private loans. The difference is often 100 to 150 basis points on average when comparing unitranche spreads to that of the term loan B market. There's less deviation when comparing unitranche to term loan B plus second lien spreads on a weighted average basis.
That's very helpful context for our listeners. As we look today and through the balance of the year, can you touch on current market conditions?
Sure thing. With M&A activity still light, though picking up, many borrowers have taken advantage of a strong market and repriced or refinanced their debt. 38% of direct lending and 86% of broadly syndicated transaction volume has been refinancing activity for the first half of this year. Loans backing buyouts have gained significant momentum in the second quarter, helping to drive volumes, which is good, but still light on a relative basis. So far this year, direct lending LBO volume is roughly $40 billion. That's up 55% from the same period last year and accounts for approximately 30% of all activity. In the syndicated loan market, LBO volumes are up year over year, but it remains a much smaller percentage of the total market volume. Both loan markets are sitting on ample liquidity. Direct lending fundraising momentum has continued, and CLO formation is in very good shape. While new money transactions have increased, the levels are still light relative to market liquidity, creating a supply-demand imbalance. Absent any shock-type events, the market should continue to coexist and offer borrowers attractive options.
Okay, you highlighted volume changes year on year, but how should market participants think about terms today compared to, say, 21, 22 timeframe, or even from last year?
So credit spreads in all markets have compressed, with direct lending following the lead of the syndicated market. As noted, strong liquidity and muted M&A creates an imbalance benefiting borrowers. A best-in-class LBO today is pricing nearly 200 basis points inside where deals were getting done through late 2022 and early 2023, and have crossed inside the lows we saw in 2021 and early 2022. Direct lenders are also offering cash flow flexibility features like PIK interest to increase attractiveness. With less cash interest, leverage levels are ticking up. Documents move tighter in the lender-friendly 2022-2023 period. We have seen some loosening of terms back to the 2021 levels, but there remains a strong focus on preventing leakage and priming transactions.
It sounds like this part of the market remains very dynamic in a specific reference to terms in reacting to market demand. Okay, so changing course here for a little bit. If I'm a corporate or a sponsor trying to assess the merits of raising financing in the direct lending or syndicated market, how would I think about one versus the other?
There are a handful of reasons borrowers consider the option of direct lending versus syndicated. The first thing people talk about is speed and certainty of funds. In both markets, the borrower is going to a select group of partners. For broadly syndicated loans, it's banks who later distribute to CLOs, hedge funds, etc. For direct lending, well, it's the lenders directly. While both provide speed and certainty of commitment, the direct loan also provides certainty of cost. Said another way, the direct loan is priced at the time of commitment, while syndicated loans are subject to market movement, up to a cap in the case of M&A, creating potential upside or downside to the borrower when they take the deal to market. For transactions with a long lead time to close, locking in the rate with direct lenders can be more appealing. Second, direct lenders offer the full debt stack, including the revolver and the term loan. Collapsing tranches creates one lender group as opposed to as many as three in the syndicated market, meaning the revolver, term loan, second lien are all provided by the direct lenders. Third, direct lenders can offer more tailored financing solutions for borrowers. The most common example is unfunded capital in the form of a delayed draw term loan to support future M&A needs. Roll-ups are a great example of that. Another use case would be carve-outs, where accounting is complicated. Fourth, confidentiality of process. Not terribly dissimilar to banks, but direct lending allows a borrower to work with fewer counterparties to maintain confidentiality, and there is no need for a ratings process. These loans are also generally not traded, which further enhances confidentiality. Lastly, borrowers generally have constructive and smaller lender groups, which can be helpful when amendments are needed. The first analysis almost always is quantitative, i.e. cost, but there are also a number of qualitative reasons we've discussed as well.
I agree with you, Jeff. While cost of capital is an important factor for deciding to fund in one market versus the other, there are important considerations that also drive these decisions as well. I'm going to tack away from market conditions for a bit and want to touch on market participants. Many of the participants in direct lending space are not banks. Can you discuss how JP Morgan participates in the direct lending product class?
Of course. First and foremost, our direct lending efforts to date have all been through our balance sheet. While direct lending is a buzzword today, it's what we've been doing as a bank since inception. JP Morgan has been an instrumental lender in many ways throughout the course of history and through many economic cycles. While this portion of the lending market has been the focus of asset managers as of late, it's very much core to what we do as a bank. The asset managers in the market today are primarily capital providers, and they've done a very good job helping their clients. We can and do lend at market terms, but our goal is to be much more than a capital provider. We're a full-service financial institution with many product offerings that are valuable to our clients. We believe lending is core to a bank, and doing so provides an entry point that can be win-win for us and our clients. Being the only bank in a club of direct lenders provides us with a unique vantage point to offer other services while making it easy for the borrower. These services range from cash management and other traditional commercial banking products to advisory and capital market solutions. We aim to be one-stop shop for all our clients' needs.
This all makes sense. Thank you for this, Jeff. Can you spend a little bit more time about how the direct lending platform ties into the other JP Morgan platforms and products?
Of course, and it's a very good question. We really are one firm, one team. It's well known that we have a world-class commercial banking platform, in particular in the middle market. As John Burns and John Richert recently mentioned on this podcast, over the past decade or so, we've been bolstering our investment banking product offering to this client base. We've added scale to the mid-cap investment banking group, which is now over 100 bankers. JPM's added dedicated professionals in product areas like M&A. We continue to bolster our established mid-cap sponsor coverage team, and so on. In short, we've been methodically bringing our investment banking offerings to commercial banking clients through continued investment in people and services for many, many years. Adding direct lending to what is already a best-in-class debt franchise is another step in that process, and in many ways can act as the glue that binds the interconnectedness of our services and relationships together. I'll note that the direct lending offering is not unique to the middle market franchise. We've been offering this to all of our clients for the past few years and have had great success with small to large cap sponsors and borrowers. As you hear on our earnings calls, JP Morgan takes a product-agnostic approach as a financing provider. With our direct lending offering as part of our broader capital markets business, we are able to provide the full suite of financing options from convertible and traditional bonds to all types of syndicated loans and direct loans. Earlier this year, we established a new global banking platform that combined our heritage investment and commercial banks. By doing so, we've solidified a holistic coverage model across the spectrum of clients.
You mentioned our focus in delivering product-agnostic solutions for our client as part of the strength of our platform. I know we also look to deliver at scale for our broad set of clients. Can you speak briefly about JP Morgan's plans to grow the direct lending offering?
Today, we're operating using just our own balance sheet, or said another way, a single financing source. Now, that financing source has to be very large. We've publicly stated that we would put $10 billion of capital to work in this arena, and there's nothing stopping us from doing more. We put a significant amount of that to use already. The asset managers in this market have multiple vehicles under their banners, closed-end funds, BDCs, SMAs, etc. In addition, many of their LPs have co-investment rights alongside the fund. It's logical for us to have financing sources in addition to our balance sheet, just like the other market participants. In addition to our extensive borrower-side relationships, we also have many lender-side relationships who value our best-in-class origination platform. Some of those same clients are seeking access to this asset class, which we can provide. Combining our capabilities in new and innovative ways allows us to scale our presence in the market and deliver more for our clients. Overall, this is just another way we can support our clients, act as a great partner, and sit at the center of a growing ecosystem.
Thank you for that, Jeff. This is a very comprehensive overview. I think that brings us to the end of our allotted time here. But thank you again for spending time with us today and walking us through the evolution of the direct lending space, its outlook, as well as the impact that JP Morgan has had delivering product-agnostic solutions for our clients. And thank you to our listeners for tuning in to another episode of What's the Deal. We hope you enjoyed this conversation. I'm Amaury Guzman. Until next time. Thanks again for listening.
Thanks for having me.
Thanks for listening to What's the Deal. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. To stay ahead of the curve, sign up for JP Morgan's In Context newsletter, packed full of market views and expert insights delivered straight to you. To subscribe, just visit jpmorgan.com/in-context. This material was prepared by the Investment Banking Group of JP Morgan Securities, LLC, and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument.